do I think it's a good idea to maybe trim some off of your positions and lock in some profits after this insane run? Yeah. You'll never hear me tell anybody to be afraid to take profit. But that being said, the stock market has been on an absolute tear in the past week. Yet people are fearful of what's coming up in the quarter two earnings and what it'll do to the stock market. In this video, I'm going to give you my thoughts on that, plus what stocks still have tons of upside regardless of what the market does. All that and more coming up. What's up, everybody? My name is Brad, and this is Own the Chaos. The stock market is crazy, it's chaotic, and I want to help you own it in order to achieve that financial freedom you're searching for. The start of July in the stock market has been absolutely insane. The S&P has risen nearly 5% in the last 5 trading days and has been in an absolute tear. But there is a looming earnings season upcoming this month that has a lot of investors on edge. But stay tuned, because later in the video, I'm going to give you a list of stocks that will either not care or will be excellent dip buys should that pullback occur. This month, companies will be revealing how their businesses performed in the recently completed second quarter. Now, some investors may be thinking to themselves that the first quarter was probably the worst quarter it had gotten this year, but that simply is just not the case. The second quarter actually is when we truly started to experience forced lockdowns, and many companies were shut down completely. Some of them even still are. You couldn't pay me to own a cruise line before the earnings come out. It will be ugly. Hospitality, forget about it. And really anything else with profit margins that thin for that matter. Uber just announced their acquisition of Postmates, which is a head scratcher for me that they continue to put money into the worst part of their business. It just doesn't make any sense. It just keeps losing and they just keep dumping money into it thinking it's going to get better. I don't know. Uber definitely isn't one that I would want to be in at all, especially since Tesla will be announcing their ride-hailing services this year. And if they are as good at that as they are with everything else they've been into, look out, world. The estimated earnings decline for quarter 2 2020 is minus 43.8%, which is below the 5-year average earnings growth rate of 5.5%, to quote FactSet's John Butters. If the negative 43.8 is the actual decline for the quarter, it will mark the largest year-over-year decline in earnings for the index since quarter 4 of 2008, which was 69.1% decline. All 11 sectors are projected to report a year-over-year decline in earnings, led by the energy, consumer discretionary, industrials, and financial sectors. To me, though, I just don't buy that. Sure, there are sectors that are going to be hit extremely hard in earnings this season, but can we honestly believe that Amazon has suffered in quarter 2? E-commerce and remote work has arguably saved the NASDAQ, and I firmly believe that's what sent it to all-time highs, even given the depression the economy is in right now. Yes, the Fed's involved too, but you see, the stock market is a forward-looking vessel. It's already factored in those numbers that we saw back in March. What we're seeing now is what the market is expecting out of quarter 3, and while I do think there will be some pullbacks along the way, I stand by my bold prediction from a couple of months ago that the S&P will see $3,500 by the end of the year. Now look, do I think it's a good idea to maybe trim some off of your positions and lock in some profits after this insane run? Yeah. You'll never hear me tell anybody to be afraid to take profit. But that being said, I think trimming some off and giving yourself some liquidity or cash on hand isn't a bad idea for probably an inevitable pullback. It's always buy low and sell high, and well, I think we're getting to a really close high in my opinion. With that said, I think there are some stocks that still have plenty of upside despite recent movements and will keep making you money regardless of what earnings may say for the rest of the market. First up, there's Lululemon. Ticker symbol LULU is currently trading at $115 per share as of this recording. And I think this has only started to move after their latest acquisition. On June 29th, they announced a strategically important move to acquire Mirror for $500 million. Mirror makes digital workout displays that it sells through its website and operates in the same interactive space as Peloton. And so even though there's plenty of competition, we all know how well Peloton's been doing, and it isn't just because of how good Peloton is as a company, it's the demand here. Today, Peloton has yet again reached another all-time high. The Lululemon deal with Mirror will be funded with Lululemon's available liquidity sources, including over $800 million of cash, and Mirror will continue to operate as a standalone company. The Upstart Fitness brand was founded by Bryn Putnam, a former Lululemon ambassador, so this kind of makes sense, right? The two companies worked together just last year on content after Lululemon made an initial investment in Mirror. Quite a few of Lululemon ambassadors have launched their content on Mirror recently, which makes the deal seem like a shoo-in considering the two brands were already working together. Now that Mirror will operate as a part of Lululemon, management has big plans that could be huge for both companies. Here's why Lululemon and Mirror make a perfect and powerful combo in the world of fitness. If you have been a subscriber on this channel for longer than 5 minutes, then you would know how bullish I have been on anything as it relates to remote work, and Rona or no Rona, it's here to stay. Same thing goes for interactive fitness. If you've been working from home, chances are you've been working out from home too, which is why we've been seeing such a huge demand for services in this space. If you've been following Peloton since I mentioned it in the low 30s on this channel, you know how fast the market for interactive fitness is growing, and Mirror falls right into this space perfectly. It currently has an annual revenue run rate of around $100 million, and that's with a relative lack of brand awareness. How many of you have heard of Peloton but never heard of Mirror before today? Let me know in the comments, because I knew of it, but I didn't know the name, and I wasn't familiar with the brand until this acquisition actually happened. So I would love to hear from you on this. But anyways, like Peloton, Mirror has already high engagement with its products and a stream of recurring revenue through subscriptions. What Lulu can do for Mirror is help them scale into a larger business and help them become more robust with their marketing channels to lower guest sign-up costs. Not only that, but Lulu also gives Mirror access to millions of loyal guests who shop on Lululemon every single year. Lulu is also looking forward to product integration. There could be major cross-sell opportunities down the road for Mirror products in Lululemon stores, and not to mention special benefits to members of Lululemon's loyalty program, which it is currently testing in select cities. It's a rare win-win for both companies, and given where Lululemon is at this price, anything below $300 a share is a steal in my opinion, and a break over their all-time high seems very likely very soon. Next up is Square. Ticker symbol SQ is currently trading at $125 a share and recently hit its $128 all-time highs. Think this is too high? Think again. There are so many deep pockets holding into Square for the long haul. Remember when we looked at all that insider buying up on Stitch Fix when it was at $16 a share? Now look at it. It's up 90% from where it was, and it's about ready to break over $30 a share since we discovered that insane buying. The big shareholder groups in Square have some serious power over the company. In theory, as a company grows, institutions will increase their ownership and insiders often decrease their ownership over time. If the insiders believe in this thing and have their own skin in the game, it should continue to give investors more confidence in the company. In fact, the top 17 shareholders have a combined ownership of 50%, implying that no one shareholder has a majority. CEO Jack Dorsey, yes, that Jack Dorsey, holds the most with 13% of shares outstanding. The Vanguard Group with 6.4%, and BlackRock, the largest investment firm in the world, holds 4.5% and are the second and third largest shareholders respectively. Okay, so the insiders are one thing, but what else does the company have going for it? First off, there's the seller ecosystem, meaning the business owner side of things, which was responsible for processing more than $106 billion in gross payment volume last year. While this seller ecosystem is best for aiding small and medium-sized businesses, it's the steady increase in use among larger businesses as well, and that's what's really getting the attention now. Just in the first quarter alone, Square saw a higher percentage of payment volume coming from businesses with more than $125,000 annual gross payment as opposed to businesses with under $125,000, which was significant if you compare it to previous years. If Square continues along with this trend, and there's no reason to believe that they won't, they will become a serious contender with the likes of PayPal, which I still like a lot. Between the two, it's literally PayPal 1, Square 1A, whatever. By the way, if you're getting value out of this video and want more of Own the Chaos, click the join button to become part of the Chaos crew. Get some sweet badges, a daily watch list exclusive to the crew, and a weekly Q&A with me that is private to channel members. If that's something that interests you and you would love to support this channel, I would love to see you there as well. The other reason Square deserves a look and will likely go higher from here is Cash App, which is the most likely reason they'll continue to skyrocket, in my opinion. Cash App saw its monthly active users count more than triple from 7 million to 24 million between the end of 2017 and the end of 2019 alone. Now, how much do you think they've grown in this space since the Rona? Paying in cash was almost non-existent as it was, and you can forget about that now. Cards? It's still a potential pandemic spreader. Digital payments? Now we're talking. I would be shocked if Cash App hasn't doubled, and I will be very interested to see how they did in Q2. With the ability to invest directly from Cash App, move money to and from traditional bank accounts from the app, and utilize Cash Card as a traditional debt card that's linked to a customer's Cash App balance, Square looks to be as if it's unstoppable. Next is AT&T, and this one may have made you scratch your head a little bit, but hear me out. I've been covering a ton of growth stocks recently, and rightfully so. There's so much growing out there, it's insane, but in the midst of potential earnings slump, it may be beneficial to look into a company with some amazing dividends that can keep cash flowing, and that's where AT&T comes in. Ticker symbol T is currently trading at $30.44, so it's nice and cheap, and AT&T's high growth days are pretty much behind them, but that doesn't stop the company from providing some really nice income to its shareholders. AT&T is a dividend giant, and it's increased its payout for 36 consecutive years and counting. As of the end of June 2020, AT&T was yielding an incredible 6.9% annually to its shareholders, which is more than triple the average of the yield of the S&P 500. Now, you might be looking at the chart and thinking it's not really all that sexy and it's kind of boring. I get it, but AT&T is aging like a fine wine, and there's still a lot going on here. For example, the rollout of 5G networks should be a long-term positive. Though the cost to upgrade wireless infrastructure is quite expensive, as is any infrastructure overhaul, AT&T will see data consumption rise at the consumer and enterprise level for years to come. This tech upgrade cycle should help to fuel growth at AT&T's wireless division, which is where it generates its best margins, and that is always sexy, folks. AT&T also stands to benefit from an increase in consumer streaming activity for obvious reasons, and even though AT&T subsidiary DirecTV has been negatively impacted by all the streaming services out there now, the recent launch of HBO Max may be able to rope some of those viewers back into the AT&T ecosystem. And this is why I think they are such a solid company that you can shift some of those profits into in case of a pullback in the overall market. And hell, you could leave it in something like AT&T on autopilot for years to come if you wanted to. Let me know what you think about these stocks in the comments below, and if you like this video, you'll love this recent one about the top 10 stocks people are buying on Robinhood. It's quite hilarious. Or if you've seen that one already, you might like this one on how I find the best stocks every morning by using a super simple scanner that anybody can build. Please like and subscribe, and as always, folks, I will see you all before the bell, and B. Smith is out.